All right, good afternoon, everyone. Hello, Porterhouse family, and happy September. Goodness, everyone knows we couldn't wait to get through August, and I'm the first one standing in line. So thank God for another opportunity to share and talk and, discuss some tools and some tips that's going to help us all to, be more successful in this industry and to continue to grow, and grow. One of the things I'm going to be talking to you about today and sharing is just the mortgage process alone. Believe it or not, it sounds so simple. And when we hear the word process, we think that, a lot of us who have been around for a while or have worked with other lenders and things like that, it seems to be a little bit easier than what it said, but it's kind of like the old school. Remember back in the day when your grandmother and them could make a cake or some dumplings by scratch? It wasn't as simple as it's tasted, and it wasn't as simple as it seemed. And we're in the same boat when it comes to the mortgage industry. The process is so much more complex than ever before, because at the end of the day, the most important thing that you have to remember is that all banks want to know is the client able to pay back the actual lien or the mortgage or the amount of money. They want to see their ability to repay. And so it's so important that we scrutinize the whole process, and it's even more. So one of the things that they've added today is that right now we're checking credit reports and verifications of employment again and again and again and again. This is also due to COVID-19, but the problem is we've had a few cases where people were actually let go or terminated, or their contract expired right before settlement, and there was nothing we could do at that particular time. So these practices are in place, not to discourage people from buying, but to make sure that the banks actually recoup their money, and that's what they're always concerned about. They want to make sure that the client has an ability to repay. So this is one of those classes or those training sessions that's going to take a lot longer than 30 minutes. So I definitely suggest that, Jasmine, Shay, and I reconvene and talk about another date when we can continue this process. Now, first tip of the day, and I'm just going to go over maybe 3 or 4 today, but the most important thing, and this is hot and heavy, is to make sure that you expound on the 10 commandments. It's so important. I can't talk about this enough, and I know just like here in the mortgage part and the mortgage industry and the guidelines and the rules, it's repetitive, but just like we always say, faith comes by hearing, and so does prosperity. And the thing is that we have to hear it over and over, and also a good process. The 10 Commandments is so important. I pulled it out last week to share with someone, because I'm still finding clients at the last minute still using their credit cards and buying furniture and buying cars at the last minute. Some of you have heard Shay and I share that story a million times. And the only reason we shared a million times because it's probably happened a million times. So the thing is, continue to preach that. And we're going to come back to that later. So first things first, pre-qual versus pre-approval. What's the difference? What's a pre-qual? What's a pre-approval? That's the biggest confusion when you're going out taking someone around to show them a property, because there are a lot of cases where a client has been pre-qualified, but they haven't been pre-approved. So let me give you the lender's side of this process, because the lender's side, it's a lot behind the scenes that you're not aware of. A lot of lenders, and we're going to take 2 different lenders or 2 different scenarios, I won't say any names, but a lot of lenders, when they pull a credit report, they will review the credit, make sure it looks good, take a verbal information over the phone, find out how much the client made, and you can actually get a pre-qualification letter within 15 minutes. Now, a lot of times as an agent, you're happy as heck because you're like, hey, this is what I'm talking about. This person got this back to me in no time, and we're ready to get them out. And a lot of times when a lender sends that letter, and if it's a pre-qualification letter, and they haven't done their due diligence, they're sending it with their fingers crossed, their toes crossed and their legs crossed, because they're hoping that this file works out. We have a thing that we say amongst the mortgage staff and all institutions say this, is throwing stuff on the wall. And that's what they do with a lot of pre-qualifications. You throw it on the wall, you hope it stick, If it don't, you just deal with it. So in that case, if they haven't verified everything, we don't know what's going to come up later. That's why in a lot of cases, I try to do a thorough pre-qualification letter, which is slightly different. I mean, a pre-approval letter, I'm sorry. So with the pre-qualification, you basically look at the credit, get some verbal information. You say this person is pre-qualified to move forward, and that's it. But the pre-approval, that's when I go into the whys and the how. That's when I go to asking for pay stubs, W-2s, bank statements, tax returns, driver's license. Why driver's license? We want to see if it expired or not. We want to see if you're still in the area. We want to make sure that you are United States citizens. I mean, you know, and we got to verify all of this information right away. Another thing is, with that being said, we also might ask for like just to verify, do a verification of employment. We want to check the employment history. We want to make sure this person has been actively working at least over the last 2 years. And why is that important? Because stability is important. That's one of the keys to show that your ability to repay is that you are a stable candidate for receiving this loan. If good credit is important, income is important, but stability is important just as well. Now, why do we ask for documents? Like I said, we have to review them. We want to make sure that this lines up and that when we put it on paper, it's not just a verbal commitment. There's been many cases. Be honest, I had a case today. They told me the guy made $70,000 per year. He made $28,000 per year. Good try, but that was a big difference. Now, why is that such a widespread? How was this person so far off? Well, they were calculating their tax returns based on 1 year. And so that's something that we need to talk about later when it comes to the tax returns, because I would love to share that with you. But after reviewing it, we found out that the gentleman made only $28,000 per year. That's why it's so important to gather documents over and over and over. And we have to review it, and it takes time to do it. Sometimes when we've cheated, and I'm guilty of that, when we try to cheat and run through it quick, fast, in a hurry, sometimes it comes back to haunt you later. So it's very important. I know with me, I had to slow down my process with trying to execute a pre-approval letter as soon as possible, because I want to be diligent and thorough about it, because I want to make sure everything's in place. So once we get a contract, we can move forward. Now, another reason why this is important, because this is a competitive market. This is the most competitive market I've seen in a while for purchases. And you know when you're out there. Brother Shea Porter called me one day and said, hey, Mike, we're going to have to work these without even asking for seller credit or anything along those lines. And he's absolutely right. So now we have to make the adjustments in the mortgage industry and try to figure out ways that we can make our offer a lot more attractive. I know one thing that we're doing is we're going over and beyond the asking price. But another thing we're going to try to do is make sure that we can get these loans closed as fast as possible, at least commitments of 21-day turnaround time. We can do that, but we can't do it consistently. Some cases are totally different from others, and every case is totally different, but that's why the prep work is the most important. So we prep it, we prep it, we prep it, we prep it as much as we can. Prepping it means not only reviewing the documents, but then we have something called DU and LP. What's DU? DU, if you write this down, this is very important, but it's desktop underwriting. That is one of the first things an underwriter is going to want to see when they start reviewing a file, is did you run this file through desktop underwriting? It's a system that all lenders have, and it's through Fannie Mae, where we run this to see if Fannie Mae likes all the information we provided, along with the credit report to say that this person is definitely able to move forward with getting a qualification or being pre-approved. LP, for the other hand, is Loan Prospect, and that's through Freddie Mac. We normally use DU because they're a lot easier than LP, but if we have to, we'll go to LP as well. And if you read through the guidelines, it'll tell you everything you need to make this deal work. Now, once you get that, that doesn't give you the golden ticket, because it still has to go through the underwriting department, and they have to still sign off on everything. But 9 times out of 10, if you have an approval from the desktop underwriting or the Loan Prospect underwriting, 9 times out of 10, you're good to go. Everything should be fine. I am going to change my pre-approval letter. So you're gonna, if you read it, it's very generic, and I've been able to get away with that for years. But now I'm just going to add some different verbiage in there because I want any listing agent on the other side of one of your transactions or your contracts that you're submitting to know that we've already ran it through desktop underwriting and we've already gotten an approval. And I'm just going to put some other verbiage on there. I used to use it years ago, so I have to revert back to that because we want to have a strong offer, a strong letter, and a strong turnaround time. We are definitely still doing our okay to proceed, but the problem that we're having, not just me, but all lenders, because I'm getting business from other loan offices and it doesn't make any sense while I'm doing purchases for people that, I mean, I'm friends with them, but it's just that they can't get the process done fast enough. And I think we're all overwhelmed because the rates are low and, you know, a lot of refis are taking place and it seems like everyone's trying to take advantage of purchasing right now. It's a good thing. It's definitely prosperous for us right now, but we still got to figure out a way to make this work. So now that you know the difference between pre-qualification and pre-approval, and you do understand that we do have to gather documents for desktop underwriting and loan prospect, and you already heard that the documents that we need to get, W-2s, pay stubs, bank statements, tax returns, verifications of employment, which I would love to talk about those things at another time because we don't want to hold you up all day. So what's the next step? Well, once we get that approval, then we start, after we give you the pre-approval letter, you're shopping for the actual home for the client. But what we're doing is we're going to be shopping into the different programs. 99% of the time, I start out with a pre-approval under FHA financing. Why FHA? First of all, FHA is a little bit more lenient to get an approval through. FHA will allow you to have a few blemishes on your credit report, and in some cases, you can write a strong letter and still get it approved. Back in the day, FHA didn't have any minimum credit score guidelines, but now we're at a minimum credit score of 640 due to the the coronavirus. And so because of all the adjustments, everyone is actually scaled back. But FHA is a very good source for financing, but that might not be the final source. So with FHA being a government loan, which only requires 3.5% down towards your transaction, there's also another one that we like to look at, and that's conventional financing. Now, conventional financing, what is the biggest difference? Everyone always asks me what's the difference. Well, I can tell you the one thing that's not true about conventional financing is that you are not exempt from paying mortgage insurance. A lot of people call me and say, I want to do conventional so I won't have to pay mortgage insurance. You pay mortgage insurance as long as you don't put 20% down. And I really do, I highly doubt if anybody's putting 20% down. It's happened once per year. And the thing is, if you're buying a $300,000 loan or $3,000 home, $300,000, and you're putting 20% down, that's $60,000 up front. So that puts you in a weird situation, and we don't have a lot of clients that's doing that this day and age. So with that being said, we're going to have mortgage insurance in all cases. And with that, with the mortgage insurance, it varies. So FHA has the better interest rates, but conventional have the better or the lower mortgage insurance. So really, when you count it all and you put it all on the paper, guess what? The thing is that they're all about the same. The difference in the payment is not even that much, $20, $30. But here's the key. If you can go conventional financing, you can help your client to eliminate mortgage insurance a lot faster. That's a topic for another day. So there's USDA, and what is that? That's a government loan. And the beauty about that loan is that it's 100% financing. There's no mortgage insurance, and it's great, but you have to find that program, and it has to be in a rural area. So there's certain properties, which I would highly recommend. If you want more information about that, give me a call and make sure you talk to Shay and Jasmine about that, because they'll tell you more about the information as far as USDA, where you can go and all that kind of stuff. Now, there's VA as well. VA financing, which is, everybody's probably heard of that by now. That's military financing, always my favorite, 100% down, no MI, great rates, and you name it. Now, someone asked me earlier from the Porter team this week, what's my view on the rates and what the market is going to look like? Well, this is my personal opinion. I think I'm 100% accurate. I think the rates are going to, maintain until at least the end of the year. We're going to have great rates for a while. I think probably by February or March of next year, maybe even, early February or early March, you might see some things change with the interest rates. I think a lot is going to have to do with the election that's going to take place. So we're going to see how that pans out. And the thing is that I think that we need to sell, go out and get clients and buyers, and let's get them in homes as soon as possible. Because I think we are going to see some changes in the mortgage industry and the real estate industry early next year. Some people are already comparing this to what we went through in 2007 and 8. I don't think it's going to be to that extreme, but I do see signs coming. This was very similar. This year reminds me of 2006. Oh, we were booming. Rates were great. I refinanced my own home, all kinds of good stuff. And it was rah, rah, rah. Agents was happy, lenders were happy. But we know that it's not going to last forever. So what's going to happen when we don't have a lot of inventory left at this particular time, and what's going to happen when the rates do creep back up? So we got to be prepared for that. But the good news, the one thing that we have an advantage over 2007 and 8 is that I think once this takes place and we do see a shift with rates, and even with the market, I think that people are going to be wanting to sell more homes, and so we're going to see a lot of people wanting to sell even more and more. So I think you're going to see an increase going into 2021 with buyers, and I think we just got to get prepped for it. Another good thing about 2021, I'm hearing that there's going to be more grant programs, because we're going to need the grant programs, and those grant programs are going to be very important, because next year, I don't know if we're going to still be able to add anything like seller credits to the market or anything along those lines. Now, I can ask you if you have any questions, but I do want to throw this out there. Now, I am clocking. I know I got 4 more minutes. One of the things I want to go back to with the 10 Commandments, it's good that we talk about that. It's good that you understand it, and it's good that you share it. But on our perspective, you have to understand the mortgage side. We got to go back to really prepping clients, and I think that part is important. And help us to help you, because that's part of prepping them when you share the commandments. But another thing is that we don't want to waste time. I don't want to waste your time. You don't want to waste my time. We want the people that are serious about buying. And one of the things that hold up the process or clogs the process are the people that are just not serious. I think we want to help any case. So we don't want to discriminate if you have some issues on your credit report. I normally say pulling your credit is a starting point, and there's nothing wrong with that. But I think it helps when you prep the client and ask them, questions, certain questions. And I don't know if Jasmine and Shay have a list of things that you can do to prep them, but I know that both of them do it all the time. So in most cases, if they send a referral, they already know that, hey, this person has X amount of credit score, this is their income, this is what we're working with. But I think if you have a person that was sent to me with maybe like a 500 credit score and they don't have a job, I don't think that that's the type of person that we want to put a lot of emphasis on at this particular time. Now, I'm not saying turn them away or discourage anyone, because we don't want to do that, because we've seen plenty of those people come in with a 500 credit score and wind up buying a house a year later. But the thing is I think when we prep it, we know what category we can put that person in and how we can present it and how we can move forward with that. So help us to prep these clients and get them ready. Now, on a positive note and a super good note, there's still programs out there now. And that's really weird that a new one just popped up not too long ago that PG County is doing. The problem is that particular program might take 45 to 60 days. So, sorry about that. So if you are a listing agent, you don't want to see anything on that program that's going to take 45 to 60 days. But the MMP program, which is CDA, which is flying high, which they slowed down, they just started picking up their pace again. That is a good situation to be in, Because right now, and I was a little nervous when Mr. Porter and I was talking, and he was saying that we need to work on, getting these deals some other way. And I was trying to figure out how, because I felt like CDA and MMP was behind. I felt like they were way behind and they were dragging, but they're beginning to pick it up a little bit. And so now we're getting answers and responses within 5 days. So I think that's a good note for all of us, because now if we can go in there and sell a CDA MMP loan, and we can present it that we can do this in 21 to 30 days, and we don't need any seller help, and it's a good interest rate, and we got a strong offer letter, and you guys presented a strong offer as far as the contract with an additional letter in there, that looks like it's a win-win situation for everyone. Now, someone just asked, what are CDA and MMP loans? Those are down payment assistance programs that's in the state of Maryland. And it's called the Maryland Mortgage Program. You can pull it up, you can look it up, but make sure if you do and you decide to go that way, give me a call, because there's a lot of quirks to that program. They do have minimum credit scores of 640, but what they do, and I'll tell you about 3 of them, they give you money towards your down payment. One of them, they have the standard one that we used to use back in the day, and that was $5,000 towards your program or towards your down payment. The thing about that program, when they give you $5,000, you have to stay in the house for 10 years. If you move or you refinance within those 10 years, then you have to pay that $5,000 back. Not the full amount, but a prorated amount. So if you did 3 years, you probably owe like $37.50 back. So that's the case with those programs. Sorry, guys. But with the other programs that they also have a 3% grant program and a 4% grant program. Best program ever. Now, here's the good thing about that program. They're going to give you 3% towards your purchase price. So $400,000 loan, you get $12,000. $400,000 loan and you want 4%, you get $16,000. You're forgiven after day 1 after you go to settlement. So you don't have to wait the 10-year time lapse to be forgiven. You are forgiven the very next day. Now, the only catch is that they have a higher interest rate. And the way we try to beat the system, or the way I beat the system, is that if I put you in one of those programs with that grant program, let's just say we went to settlement this month, then you have to make 6 payments so that we can actually get you out of it. They do require, and FHA requires that you make 6 payments before you can refinance. You can refinance to a lower interest rate and you can get out of it. The current rate today for the 3% grant is 4.125. The current rate for the 4% grant today is 4.625. So basically, what am I saying? Nothing's for free. I mean, they definitely give you the money, the grant, but they do make you pay with a higher interest rate. But even if you keep it for like only 6 months, it's a win-win situation all the way around. And so, and last. Back to the whole loan process and closing this out for today, because I would love to continue this. The mortgage lender, after we get everything done and you're out taking your client and we have a ratified contract, one tidbit that we have to continue to do, we have to make sure, especially this day with our clients, we have to continually monitor them. We have to, even more than what we've ever done before. Because I'm finding more and more people doing stuff at the last minute. I had a deal that's supposed to be closing tomorrow. He went out and got a new credit card, a $245 a month credit card, because he wanted to buy some jewelry to surprise his lady. Sweet, that's nice, thank you. I appreciate you being sentimental, but I can't believe that, this gentleman went out there and did that. So with that being the case, if he went out and purchased that, he didn't realize that that's a $245 payment per month that he just added to his debt to income ratio. Now, we've talked to him. We schooled him, told him don't do it. He thought because when he received an email that the loan was approved, he was able to move forward and just get back to regular living. Well, this day and age, it doesn't work that way. And what happens, and the reason why we have to keep monitoring, is because 3 days before settlement, we will actually review your credit report. They will pull another credit report just to make sure. It's not an actual credit report, but it's called a refresher. And the refresher basically means that, is there anything new on that report? Any new accounts that you open, anything? And that's when we saw it. Matter of fact, that's happened twice to me this week alone. 2 clients just did stuff with their credit, and it's my job to fix it. Now, thank God in both cases, I found a way to fix both of them, but it's putting us on hold, and it's pushing settlement out another couple of days. Another thing that they do right before settlement is that we do verifications of employment. We got to keep saying that. We got to keep going over that. Why is that so important? Because again, we want to make sure that that person is working there, but we're beginning to have problems. So I think as we continue to monitor our clients, work together as a team, we have to even work with even getting hold of our HR to get a verification of employment, or at least let the client know, because they will not release these docs for us to go to settlement. We could be sitting in here with a clear to close, and everybody can have their new suit on looking like Curtis. and the thing is that you're all ready to sign on the dotted line, but yet you can't move forward because we haven't verified your employment. I hate to hold up settlements, and I hate to hold up settlements over things that's just very minute. We should not be holding up a settlement just because of a verification of employment. We shouldn't be holding up a settlement just because of our credit, but that happens. Excuse me, guys. I got to cut my phone off. I am so sorry. I should have had it off early. Okay, there we go. So with that being the case, we have to work together to monitor the process, and we have to make sure that we're monitoring what they're doing. Another reason why this is important, because the underwriter is going to look at this, and then they have another form that they put, well, a process that they use to evaluate certain things. If you, here's a good example. Someone presented a case to me. A lady, I think she had a bankruptcy and never showed up on the credit report. Well, what the underwriter found out in 2 seconds that she had a bankruptcy. The person denied it, and we kept going back and forth. So you're trying to call me on the phone, you're trying to get a hold of me and talk to me about a new client, but I'm spending 45 minutes on one conversation, going back and forth with an underwriter and the client, because the client is real, just standing tall that it didn't belong to them, only to find out that it did. And so I don't know why they wanted to buck the system, but the problem is the underwriters are going to make sure that they protect themselves as well. A lot of people have asked me, well, can't they turn to the left, turn to the right, or sign off and approve it? They could if they wanted to, but if this thing backfires for an underwriter in this process, then they're fine and they could lose their job. And at the end of the day, we don't want to see anyone lose out. We don't want to see anyone lose their job moving forward or anything like that. So, the 10 commandments. It's very important for when we talk about pre-qual versus pre-approval. I already talked about why we need to get some documents, but I'm gonna go back to that because I got a little bit more time. Now, here's some of the things that what we look at when we look at these documents. I get a lot of times people say, okay, such and such, makes X amount of money per year. So let's all work as a family. Let's work as a team and check this out. You come to me with this client, and let's say John Doe makes $45,000 per year. And so if we base this pre-approval off of that, that's very good. And so, and we're just going to use this so we can keep up with the math. Let's say $50,000 a year. So John Doe makes $50,000 per year. We pre-approved Mr. Doe, and we're moving forward. Dee Richardson is taking him out, and she got him going and everything. But now we found out that we have to increase his buying power to be a little bit more competitive. So she called me and asked me if we can increase it. We increased it a couple of bucks more, but I'm still waiting for his verification of employment to come in. So let's say his buying power was 200,000. So we're at 200,000, but to make this deal work, we got to get it up to 220. Based on his pay stub that I've seen and his W-2s, he makes $50,000 per year. He's fine. But we don't stop there. That's why the verification of employment is important. So we're moving forward. D got the contract. Everything's great, but the verification hasn't come in yet. 2 days into a ratified contract, we're ordering everything. The verification comes in and shows that his year-to-dates never matched up to the $50,000 per year salary. And so this is a uh-oh moment. Why is that? Because even though this person is guaranteed to try to make $50,000 per year, John Doe took off, let's say 4th of July just passed. And 4th of July, a lot of people, it wasn't a paid holiday for a lot of companies. So therefore, John Doe took off 4th of July. Well, those 8 hours that counted against him, and John Doe decided to do leave without pay because he wanted to save his leave for a rainy day, which is fine. But now that just knocked his income down, his year-to-date average. And then John Doe took off, let's say Memorial Day was on Monday, and John Doe wanted to take that Tuesday off. And then John Doe took one more day off to take the kids, take little John Doe back to school. And so with that being the case, that's 3 days, that's 24 hours that has affected his year-to-date. Now, we're looking at this person who was supposed to make $50,000 per year, but now they're gonna be short. And so once we get that year-to-date average, and you have to balance it and you have to look at it because what the proposed amount and what he made are 2 different things. So we know he's supposed to make 50 if he stay on course, and that's fine if he doesn't do anything. Matter of fact, I would encourage him to go ahead and get the house first, stay on course, and then take those 3 days. But the thing is that he didn't. So now we're going to show his year-to-date average, which might change his debt-to-income ratio, which would create a problem for financing. This is an important moment throughout the process. That's why I'm always big on trying to get a verification of employment. I will hold up a pre-approval letter for getting a verification of employment because a lot of the clients that all of us going to deal with, we tight on our income. We could be tight on the credit scores, and there's nothing wrong with that. But in order to make this work, we got to also go an extra mile to make sure, because even if we do it, it's still something can pop up. So you have to be in tune to what's happening with that, because that's another process that's important. And again, verifications of employment are taking a lot longer than they used to. Now, here's the funny thing. The verification of employment has something called a work number. Some of you have heard of it. A lot of our clients call me and they reach out to me and they're like, well, Mike, it's on the work number. So once I get the work number and I review it, that could be another uh-oh moment, because a lot of times the work number is very generic. They don't have the proper overtime. They don't have the proper bonuses. And so that's when I have to go back to the HR person that I think that same HR person that I call works at the Motor Vehicle Administration, because they got the same attitude. But the thing is that we send this back to that person. This person looks at it and says, I'm not doing this verification of employment because you can get it from the work number. Then I have to go back and forth and fight with this rep who doesn't want to do this. She doesn't want to be here. She doesn't want to work from home. And she's about to take her 2-hour lunch break. And so with all this being said, it could take an additional 2 to 3 weeks just to get a verification of employment from someone else, because they really don't have to do it because we already got the information. But on the other hand, I need it because I looked at it and I know my numbers, and I know that there's something wrong. And so with that being the case, I got to press them. I get it. And next thing you know, just like the other one worked against us with the year-to-date, this other one, which we call a written verification of employment. You might see the acronyms, WVOE. That's for a written verification of employment. I like to get that one because that spells out everything. So if I need bonuses, if I need weekend income, if I need night differential, if I need extra commission, if I need part-time, if I need any of those items to make this case a lot stronger and to figure out a way to finagle it and make it work, then that's what I have to do. Prime example, I have a deal now and it's closing on the 15th or the 14th. Couldn't get it to work. And this is a great story. This is perfect for our whole loan process. So I get this contract, pre-approved the person, everything's fine. We did 3 verifications of employment and the debt to income ratio was super tight. It was probably like at 54%. Well, the verification of employment came back on one of the borrowers. There's 3 borrowers, but one of them, it came back. And when it came back, it indicated that the borrower's position had expired for his job. So I call the clients. I'm like, dude, we can't do anything. I mean, uh, that just killed our loan. And then we had a 67 debt to income ratio, and he's not working. Now, they said that they heard that if anybody can fix it, I might be able to. And I said, okay, well, you got to give me some time to see what I can do. And so we did it. And the gentleman did find another job, but the other job that he found was less income. Now, because it was less income, we still didn't get the numbers to work in our favor. So now, based on the information that I have, I still can't make this deal work. So then I go back to the first borrower, and I'm looking at his verification of employment from the work number. I'm going back and forth. And you don't understand, sometimes it might seem like it's a long time, but sometimes the answer, the light switch don't come on right away. You got to look at it again and again. And I promise you, I looked at that verification of employment over 20 times, and I just couldn't put it together. But this one time, and it was Monday, I looked at it, and I said, oh man, something's wrong here. Called the client, found out he gets an additional, I forgot what he called it, but it's like, I don't know. It's just it's an encouraging type of income that they give them for good stewardship or something like that. I forgot what he called it. I'll tell you the truth. I've never even heard the terminology before. But I added the numbers up and I looked at it and I said it was wrong. So I challenged the work number. Come to find out, after I confirmed it with the client, he said, yes, I get additional income, and the numbers didn't match from what I had on the work number. So then I had to go back to HR, beat them up, and then they made me pay them for another verification of employment only to give me the same work number one. So we're going through this. We finally got the client involved. We called them. They gave me the information. I received it maybe 11 o'clock last night. And now this loan is approved and it's ready to go, and we're good to go. So that's why that verification part is so important. And, you know, we got to look at it, and it's important for us, especially this day and age, because we need to see what the income looks like and where we stand. Plus, at the end of the day, it's so important to get it up front because we don't want to waste your time. We don't want to waste the client's time. We want to get to the settlement table. That's our number one goal. Just like the bank's number one goal is to guarantee the ability to repay is 2 thumbs up. Our number one goal is to get the clients to the table. Excuse me, both listing and buyer side. Now, another verification that we do is we do verify student loan debt. I'm not going to go into all of that right now, but student loan debt is very important. There's a way that we can verify how long the debt is. And so why is this important? So this might be a tidbit if you don't know, but for student loan debt, we have to count that against every client. What do I mean by that? And why? So what I mean is that they want to have a monthly debt going against that client if you have a student loan debt, and that counts towards our debt to income ratio. It used to be back in the day, if it had deferred, regardless to anything, if it had deferred payment, and we knew that we can count that it was deferred for at least 3 years, then we didn't have to count that against the client. But the industries got tired because they were getting burnt on deals because the clients that was losing their homes due to foreclosure, a lot of people, number one claim was the student loan open up. So the one that we didn't count against them to get the loan done, and then next thing you know, it ballooned where they had to make the payment, and that payment set them back. And so, you know, instead of defaulting on the student loan, some of them defaulted on the house, pick and choose their battle. So then we have to count it against them. And how do we count them against them? So there's FHA, and then there's Fannie Mae, and then there's Freddie Mac. And FHA, we're going to say FHA and VA all together. They count the student loan debt 1% against you, regardless. No ifs and buts about it. And there's one trick I can get around it, but I can't share that trick because that's for me only. I got to keep one in my bag. I don't know if any of y'all ever played spades, but I'm keeping that big joker. So the thing is, if you have a $2,000 a month student loan balance, then they're going to count that against you, 1% of that balance. And that's how it is for every loan that's under any government, FHA, and I meant to say USDA and VA. But if you go to what we call Fannie Mae conventional loans, Fannie Mae is pretty cool. Fannie Mae would count only 0.5% against you, and actually Freddie Mac. So if you have a student loan debt, let's just say, what is it, $20,000 debt, and we're supposed to count $200 against you for FHA or any government loan. If we try to convert it to a conventional loan, then we only count $100 against you. And then in some cases, there's something called the IDR. Get familiar with that. What is the IDR? It's the individual, what is it? Oh, geez, I don't even know the acronym. I'm sorry. But it's basically income-driven repayment plan. That's what it is. I'm sorry. Income-driven repayment plan for student loan. So if they have that, I try to encourage a lot of clients to get that right away up front, because if they have an income-driven repayment plan and they're supposed to pay $200 per month, but that income-driven repayment plan has $23, I get it uploaded to their credit report and we're good to go. So we can use that. And like I said, there's another trick to get around the FHA component, and I've done it a couple of times, but that's more detail. So keep in mind, that's another verification that we have to check. Another one is the verification of rent. That's so important. A lot of people say, well, why is the rent important if I paid on time? Well, this strengthens your file. If we have a good rental history and we can support that with good financial income, or we can even support it with some credit, good credit history, that makes our case even stronger with that. So these are some of the verifications that we like to get early up front that make your life a lot easier. Another thing that I like to do up front now, and I'm beginning to do that in the pre-qualification status. I didn't used to do this, but now I'm ordering tax transcripts up front. And I like to order what they call a W-2 tax transcript. I like to order the tax transcript because that saves some time going through the process of getting everything done. So I've given you a lot of tools of what we do from the process, and that's just probably just the tip of it. There's so much more. The funny thing about it is that even with our process, we have guidelines and we have the map of how we have to flow, but then there's a lot of times we have to take detours with this, and we have to go in a different direction to make our deals work and get back on track. So after you get through all these verifications, and then we try to upgrade everything with getting a tax transcript, and we've definitely did our, dot our I's and cross our T's. Our next step is to try to get this loan into underwriting. It's nothing greater than a clean file. I love when we can do it up front because it makes your life a lot easier, makes mine's, the client. And I don't mean clean to say that there can't be any spot or wrinkles. I mean clean to make sure that we iron them out before we got to the underwriter. I love to do that. I love when I see something on a credit report and I address it up front. But this is where we all got to work together. This is where I need to be more vocal and in tune and make sure I'm communicating with you to let you know that, hey, Ms. Bowie, this is what we need, and this is going to be a problem. And we need to push this up front. I think I got Christine Britt helping me on one now that we talked about today, and she said, I got to get involved. Because, and I'm guilty of that because I have to utilize you more when it comes to things like that, because I forget. Sometimes I think I'm Superman, but I need to realize that we're the Avengers. So I got to change my whole philosophy and understand that we're working as a team. And so if we can get these things up front, that makes it a lot easier for the whole process. Underwriters love it. It's nothing greater, and I was beginning to say this, it's nothing greater when the underwriter says, Mike, this is a great file. Wow. We love that. It's nothing greater than that. I mean, we know it's a slam dunk. And we like when we get that like 6 to 10 days in advance and we're ahead of schedule. But we got to make sure that we're all doing our part to prep the client. Now, after the underwriter gets it, there's another important piece that we forgot about up front. So I got to go back. Sorry, I got to hit the rewind button. We got to get the client to get docs over fast as possible. That can slow up the process of getting a loan in the file. Getting in process. I got a loan now that I got a contract Monday, and I just got all my documents mainly yesterday, and there's still some missing. So technically, I can't submit a clean file, so I have a choice. I got to make a choice. Do I send it sloppy when I know that there's stuff missing and try to sneak it in later? And a lot of times I do that and I get bit. Or do I wait to present a good file? So today is Thursday. I've been trying to get this stuff since Monday, and yet we still don't have it completed. So we have to make sure we push, and this is when I got to push you now, and I got to be able to call Shay and say, hey, Shay, this client didn't send me my stuff over, and I got to send a pit bull on him, and then he'll go out there and make sure he pushes them to get it and say, you're going to have it within 30 minutes. And so that's so important because sometimes people tend to think that, you know, I can relax a little bit. I got the contract, but no, there's no relaxing in this. We want this done right away. Not only with that, but there's another key component that we need to explain this. And I think we should all do this up front. There's the appraisal fee, and then there's a home inspection fee. And a lot of times I get pushback on appraisal fees sometimes. Because if they hold back, or if John Doe says, Mike, I can't do this until I get paid on the 15th, we can't order appraisal. And trust and believe that will slow up our process. Appraisals are slam this day and age. And with them being backed up, and then we waiting another 7 to 10 days to submit this financial request for it, that just holds up the process. One of the things I used to try to do sometimes was I would pay for the appraisal myself and then get reimbursed later if the client didn't have it. But right now I'm probably out about $1,800, and I'm still trying to figure out how to recoup some of that, and that didn't work out. That didn't work in my favor. Maybe not 18, maybe 15, but still, that didn't work in my favor right now. So, you know, I have to wait till that person can come up with their money because I can't get shortchanged on that. And, you know, we want to make sure that we're doing that. So you have to push that, and we have to push that as a team to be able to say, hey, the home inspection is optional, but I encourage everybody that they should get it because you want to know what you're getting into. And so I encourage it on my end. I'm always telling them, you don't have to get it, but you should get it. You will want to get it. And I'm not saying you have to, but definitely do it. So I encourage it. But the appraisal part, sometimes they don't know the difference. And in some cases, not all cases, but in some cases, they ask me, well, didn't I just pay for that? No, I have to explain to them what the appraisal process means and why we're getting this, because they need to know that the appraisal is the main piece, or one of the main pieces that we need to support the collateral of this whole loan transaction. I don't think a lot of times they understand that their appraisal is collateral. We just want to see what it looked like. And the bank is using this because the bank basically saying, this house is the only reason why I'm giving you a loan. And I don't think that that's pushed or presented enough. And so, and we all are guilty. I know I'm guilty. So now I'm beginning to find myself to going back over that. Because, I mean, let's face it, when you've been doing this stuff for many years, sometimes you tend to just slide by stuff and just take it for granted. So now I got to go back and say, make sure that they understand that this appraisal process is very important. You don't want to slip on this. And they also have to understand that you got to pay for this up front. And so, but it is deducted from their closing costs once they go to settlement, if they go to settlement, okay? So if their closing cost was $10,000 and their appraisal was $500, then they're gonna be bringing $9,500 to the table. In some ways we can, in some cases we can give a credit towards it sometimes, but we can only give a credit at settlement. Now, my last thing, I'm gonna close out on this. What's going on with lender credits? They are not the same. All these lender credits changed when they made all the announcements when they changed due to the virus. We used to be able to get credits, and I know Jasmine and Shay would give me an amen right now because we gave credits like never before. I think we gave credits like, I don't think nobody's ever given a bigger credit than me in the history of lender credit.
Amen.
I'm telling you I gave them, and I'm still trying to give them, but it's not the same. So what they did was they condensed it, they worked it out, they kind of restructured everything to put us in this box just a little bit to say, okay, we're gonna allow you to give a little lender credit, but it's not too much. And it is always based on the interest rate, but we don't have too much of a window like we used to. What do I mean by the window? I think there was one deal that the Porters gave me. It might have been a $350,000 deal. We probably gave that person like 3.5% credit from the lender, and we're still able to give a good interest rate. Now you're talking about, what is that? That's over $10,000. Can't do that anymore. The best I might be able to do is $3,000, and you got to pull teeth to do it. If you're working with a broker can't even do it. So here's a good tidbit for a lot of the brokers. That's why the banks right now are the strongest things you can work with right now, because the brokers now have to add fees to cover things that they didn't used to have to deal with before. Because of all the revisions to FHA and everything, that's why I'm getting deals from other lenders. I mean, for this week alone, and I had to turn one of them down. And look, I am not in a situation to turn down a deal, but I had to turn down a $525,000 refinance from my boy. I said, dude, I can't do that right now. I can't do it because I got to focus on my pre-approvals. I messed up by trying to help you out before, and I can't do it. But the thing is, the reason why, and he told me, call me back and said the client is willing to wait. It's a refinance. The key is he can't give him a good rate without charging him origination and points. And so that's the thing that a lot of the brokers or some of the lower end, smaller companies are doing. I'm getting offers left and right to leave, jump ship, and go to these other companies. And my signing bonus make me feel like I'm in the NBA. But I can't do it because I already know on the other end, once the signing bonus is received and I spent it, then how am I going to give a decent rate without charging the client X amount of money to get it done? And so we're already in a tough situation when we're trying to find money. And then, like I said, Porter said it earlier last week, we can't actually do seller credits like we used to. And now we know that the lender credits have been reduced. And we got to find the programs. The last thing you need is for me to add origination fees on top of this to try to make a deal work. So with all I said, our work is cut out, but it's fun. I said all that to say, that's the thing you gotta love about this business. If you're an agent and you're a lender and you're not loving these changes, then you don't enjoy it. I'm telling you, I love this. This is one thing to keep me excited about because everything changes. It's like I love all seasons. I love all seasons. I'm not a person who loves summer only and winter only. No, I love all 4 seasons. We get to change. You gotta change it. You gotta adapt. I love it. And that's where we at. So all of us that's listening, we will be successful with this. We will come out on top, but you got to enjoy it. We got to have the right attitude. We got to have the attitude to adjust, and we got to just know and speak it and claim it. And you have to, you really have to. And I'm not just saying that, claim it. I claim my victory every day. I thank God for a lot of miracles. And I know a lot of people have given me credit, and I thank God for a lot of miracles I pulled off, but I give God all the glory for it. I'm serious. I know, because I know when I get off this phone and I had this tough deal and Shay just called me and we talked about it. And when I get off the phone with him, I got to go in my prayer closet real quick because I can't do this by myself. And I told Jasmine the other day, I already figured this out. I figured that God always wins and I always lose. So we got a thing going now. As long as I understand my role, it works for me. And so I'm encouraging you guys as I close out, continue to be blessed, continue to go get the business, continue to enjoy it. This is fun. I'm telling you now, it's fun and it gets better. And thank you for today. And I'm gonna turn it over to Ms. Jasmine.
Excellent job, Coop. Excellent job. Thank you so much. That was a lot of great information. And we're looking forward to having you back again because you're gonna have to unpack some of the things that you've shared with everybody today. So that was phenomenal. Let me see. I think you have a question in the chat. Oh, that's Herman. He said he's going to second that notion. Amen. You did a great job. So we are very excited. I'm going to stop the